This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscaping by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus and Dianne Crocker. For the week of September 9th to the 13th, the presidential debate between Trump and Harris brought talk about the economic policy to the top of the news cycle. And in data released this week, both consumer and wholesale inflation showed a continued trend in moderating, despite core prices coming in slightly hotter than expected. This is on the heels of Friday's jobs report, which is fueling market sentiment that the Fed is in a good place to begin its policy shift. Manus, it seems that the only question is how much should the Fed cut next week?
That is the big question. And I'm not sure if it's 25 or 50. I'm leaning towards 25. And the reason for that is, I think Barron's explained this really well last week in their Saturday morning edition, which I'm a religious reader of, that the Fed has really only done a 50 basis point decrease during really unsettled economic times, the great financial crisis, the dot-com bust during COVID. It's only when you're seeing the real erosion of the economy in short order do they make that kind of move. So I think, if I were to bet on this, I think 25 basis points really sounds like the number. I tend to agree with Barron's wholeheartedly on that. I think the bigger issue right now may be that we're going back to where we were in December of 2023, in that I think there's way too much exuberance for how deep the Fed cuts will be over the next 6 to 12 to 18 months. I think we're back to this notion that 18 months from now, the Fed funds rate will be 200 to 250 basis points lower than it is today. And I don't see any indication of that. Yes, the economy's slowing, but we're not really looking at recessionary indicators at this point. The retailer comments last week were concerning, sure, but it does seem that the markets are really getting ahead of themselves if they're thinking that 200, 225, 250 is where we're going to be by early 2026. I just don't see that playing out at the moment.
It kind of reminds me, Manus, of where everybody was in January. I mean, you might remember folks were predicting as many as 3 or 4 cuts by mid-year. And I think Ryan Severino was the only analyst I talked to that said, no way, that's the Fed getting way too far out over its skis. And he was the only one who said that we probably wouldn't see a rate cut by now. So, here they are again doing the exact same thing 6-7 months later.
Inflation, even though it's coming down, prices on average across a wide basket of things is still 20% higher than where it was 2 years ago. The compounding effect of 2 years of inflation is real. That is still a fresh reminder, not only to Fed decision makers, but to the average American consumer. And I think that if there's a mistake that the Fed wants to make, I think they want to make the mistake such that the inflation dragon is really slayed right now, that we don't have this reverberation that they cut too fast, rather than the other problem, which is they cut too slow and maybe they tap the brakes too hard. That's my gut. You're absolutely right that late 2023, early 2024 vibe, where some people were saying 6 cuts this year, which seemed crazy at the time. It turned out to be crazy. I think the same people are now saying 6 to 10 cuts over the next 18 months, and that too seems wildly optimistic.
But hope springs eternal, Manus. I agree with you, though. I think a quarter point is much more likely. And for our listeners, the point that you made earlier is valid. I mean, we will probably get a quarter point, and we should be grateful, because a higher one would be really a bad sign.
I saw a report that said, and it was one of the more conservative ones, that said we'll see a cut in September and perhaps another one in January. Manus, to your point, that sounds a little bit more conservative than some of the other estimates.
I would say that that's on the conservative side, but I don't think that that's outlandish.
The core CPI number, which is something that is closely watched, it excludes food and energy. And one of the things that it also considers is shelter, which is an important component of CPI. And for people who are really into looking at the economics of this, some of this feeds into the PCE, which is what the Fed looks at extremely closely.
I don't think you can neglect at all what the housing impact is on the Fed right now. And I think that a lot of the people that are making these multiple 25 basis point drops are ignoring one really important thing, and that is that housing prices remain extraordinarily high. Housing prices, housing itself is unattainable for many people under the age of 30, right? We said in many markets, a starter home is running seven figures right now. And I do think that that's not lost on the Fed. A 50 basis point rate cut, 100 basis points by the end of the year, 150 basis points by mid next year would set the housing market even more on fire. Lower borrowing costs would lead to a real spike in people trying to buy homes, which would, of course, drive up prices again. And I think that's one thing that the analysts are neglecting right now, that this is so unaffordable for the average American right now that to fan those flames with multiple rate cuts would border on irresponsibility. 25 basis points, fine. 50 basis points, fine. Give some relief to the commercial real estate market. But if you're talking more than that, I think you do run this risk that an already overheated housing market just gets completely parabolic. Is that a good word for it? It just goes off the rails.
Housing certainly is going to be a concern. I agree with you, Manus, that the Fed is going to keep their eyes on that. There's also the issue of consumer credit. Consumers are still weighed down by debt. And there were two reports that came out that really spoke to that. The first was the Fed's consumer credit report, which showed revolving credit continues to hover above $1.3 trillion, which surged in 2023. So it's currently 25% above 2019 levels. And then the second was the average perceived probability of missing a minimum debt payment over the next 3 months increased by 0.3 percentage points, which sounds small, but it's its third consecutive increase and the highest since April 2020. So when you talk about how expensive starter homes are, you think about it in terms of consumers that are already weighed down by debt, and your point makes sense.
I think it's a big issue right now. Martha started off with a remark about the debate happening this week, and Martha knows me from years back that I don't weigh in on political matters on the podcast at all. I like to keep my opinions my own, but I do think that costs for housing, costs for groceries, the direction of the economy, all of those things will continue to be a front and center focus for people for the next 3 or 4 months. I'll go back to a remark I made a few minutes ago that if the Fed is going to get this wrong, they want to get this wrong on the side of squeezing inflation out of the system, not cutting rates too fast. They prefer one mistake over the other. I think that that's where we're headed. And I sympathize with that. I do think that for the average American where, they're living paycheck to paycheck and things have been higher the last couple of years, I want to see them get relief for sure.
And we're actually going to have Mike Flood from MBA on our podcast next week, diving into the economic impact of a presidential election. And he's pretty good at staying above the fray and sticking to what are the policy implications and outcomes for the CRE market. So we'll be covering that. Despite all of the bad news we've bandied about here, there was a silver lining report that came out this week from the Real Estate Roundtable.
The Real Estate Roundtable came out with their Q3 2024 Sentiment Index. I love looking at this report. It's a broad-based survey of investors, and they do a great job of summarizing how executives feel about expectations and confidence measures over the near term. And their latest Q3 report is an overall score of 64, which was up 3 points from the previous quarter, and an 18-point increase in the overall score since last year. So a lot of bullishness there. The future index in terms of expectations was a score of 70 points, and that was an increase of 4 points above the previous quarter. So, really kind of indicating that uncertainty has lessened. One thing that really jumped out at me in the survey was not just kind of the overall sentiment and the expectations about the near term, but it was the questions about asset values. 57% of respondents are optimistic that asset values will be higher 1 year from now. 31% think values won't change, and only 11% think they'll go down. So, Manus, I think that speaks to at least some semblance that executives are getting a sense of stability and values returning, with a strong lean toward higher asset prices a year from now.
I think one of the really underreported stories of the last 3 months is when you look at equity returns in this country, and this is something that I brought up in an internal meeting earlier this week. If you look at all of the SPDR ETFs that are out there that people can bet on certain segments, I'm not talking about like an S&P 500 ETF, but where you can bet on consumer staples or discretionaries or real estate or other segments, pharmaceuticals, the top performer for the last 3 months has been that real estate ETF, up 16% over the last 90 days, which is the best performing SPDR ETF among the dozens of sector ETFs that they put out there. And I think that there's been a lot of doom and gloom in commercial real estate. People have been slow to take the baton that things are getting better. But the reality is falling rates have shored up asset prices. People have started to put money to work. And I think it was reflected by this strong return. Like I said, 16% over the last 90 days, and that's before the last couple of days. This was as of Tuesday. People are starting to put bets, on the commercial real estate space. That particular ETF, for those that are curious, among the top 10 holdings, I think Prologis is the number one, heavily weighted towards self-storage, some data centers, lots of cell towers, a little bit of retail. As far as I can recall, not a lot of office, at least not among the top holdings, maybe not any at all, but terrific returns over the last quarter. And it brings me to a second point, which my second shout out to Barron's on this podcast. They also noted last week that there have been some buyers of big option calls on either real estate specific stocks, in one case, Cushman and Wakefield, and in other cases, futures calls on that SPDR retail ETF. So even though I think on the ground, people, brokers, buyers, sellers are still quite nervous and are not ready to buy this narrative that we're back, the people that are actually making bets seem to think that we're back, or at least we're getting back.
And on that note, we're going to now go back to the LightBox data dive, and we've got a early look at appraisal index information showing some signs of strength. Dianne?
At this stage of market recovery, I think the important work that commercial appraisers are doing is really front and center, right? Because the market is keenly interested in assets value. Think about all the moving pieces that have changed in the past year or two, and the market's really struggling to find its footing, and investors are all out there waiting for the right time to move in. Nobody wants to be too early. Nobody wants to be too late. So I can't believe that we're 2 weeks away from the end of the third quarter. But I took a look specifically at the appraisal data in our platforms, which is a measure of appraisal volume or appraisal demand specifically in the lender sector. So it's a direct relationship to what lenders are doing, whether it's for originations or refis on the growing swell of maturities, or some other reason. So based on just lender appraisal volume in July and August, the volume is indexed to an early 2021 baseline. That index just in those 2 months increased to an index reading of 72.1. And that was a nearly 9-point increase over Q2. And also it's notable because if you think about it, July and August are typically slower months of the year, the summer season. And looking back to 2023, that increase was a jump of almost 11 points. So, I'm looking at that and thinking about everything that's going on in the market. And I think there's a pretty good chance that the index for the full third quarter could land well above the 57.9 that we had in Q3 2023. So we'll see what happens. And if it comes in very, very strong, that could really set the stage for a busy fourth quarter.
We can't set aside the fact that 10-year Treasury yield, along with everything else, the 2-year, the 5-year, are just grinding lower day after day. Today, at one point, the 10-year was at 3.65%, now 135 basis points below where we were at our peak. Risk premiums have come in very significantly over the last 12 months, probably 50 basis points in aggregate when you look up and down the credit stack. So you're talking about 200 basis points lower in borrowing costs than where we were at our worst point. That has to turn into higher levels of origination. It has to turn into some of these borrowers that were on the fence about turning back the keys versus trying to muddle through, actually leaning in and trying to muddle through. That the fact that they have 200 basis points more to work with in their refinancing costs and the corresponding uptick in valuation that that brings in anything but office is going to be really important. And I think the analog here is what we saw in the residential space over the last month, where refinancings have just gone through the roof, that we're seeing just incredible refinancing numbers. And I do think that that will spill over into the CRE space in short order.
So that all leads me to our did you know stat for the week, the appraisal information that Dianne was referencing. The source of that data comes from two of our core lender platforms called C360 and RIMS, which typically procure about $500 million in services annually.
So that would be 500 million in appraisals by and large, people coming in, but it's not just appraisals, people coming in and needing their commercial real estate property valued. And as we've talked about this many times over the last 2 months, we track this regularly. We put out a report every month, which talks about these numbers. We do track it even more frequently than that. And we know that we see when there's surges in appraisals, that means that their economic activity and sales transactions will be ticking up in the near future. And when the opposite is taking place, we are expecting a slowdown. And it would not be surprising, to Diane's point, that over the next month or two, we see this number continue to point north.
It runs in sync with changes in interest rates too, because if you think about it, the high point of that index happened right before the Fed started aggressively raising rates. So it'll be really interesting to see how the index changes as the rate cutting cycle starts to begin.
And our next segment from the field is going to take us to a couple of different places. We had a couple of events that our teams attended, the NAI Global and the Real Estate Investment Advisory Council. I'm going to ask each of you to give us a summary of the vibe at those events, because I think it gives some clarity as to some of the things we've been talking about.
Well, I'll jump in first. I got reports from the field from our own Andrew Phillips, who spent a couple days on the road taking the temperature of CRE types from across the country. I would say that the narrative he gave back to us over the course of 2 days is consistent with what I hinted at a few minutes ago. And that is, nobody is exuberant yet, and maybe they shouldn't be. What we've seen happen over the last 6 months via our index is solid but modest increases activity month over month over month. This is not a, to use the word again, parabolic shift where activity is shooting through the roof. This is a slow, steady climb. And I think that the reports that we're getting on the field, from the people that are buying, selling, brokering, is we may not be out of the woods yet. Yes, there are some bright spots. Yes, we may avoid a recession. Yes, the wheels aren't falling off. But by any other measure, we're not popping corks either. We are grinding it out. We are seeing modest improvements every single month, but we are nowhere close to firing on all 8 cylinders yet. So I would say Andrew's commentary was guarded. Maybe that's the word I would use, guarded, that while nobody is panicking, while nobody thinks there's another leg down, neither are people kind of saying, let's go out guns blazing, like it's game on, right? We're going to see a fourth quarter like we've never seen before. Nobody's of that mind either.
Yeah, they're all kind of watching and seeing and paying attention to what everybody else is doing. I did hear a bit of bullishness last night, Manus. I attended the Real Estate Investment Advisory Council, or REAC's Capital Markets panel in Atlanta with my LightBox colleague, Alan Agadoni. Brian Olazoff was the moderator, excellent. And it was a panel of insurance, private equity, and banking. It was a capital markets panel, right? So interest rates came up first, and the sense was, of course, everybody's waiting for that magic drop. I heard a couple new terms. One was defaulting with dignity. I don't know if you ever heard that, Manus, but it was for borrowers who decide to hand over the keys and walk away. So defaulting with dignity sounded like kind of an elegant term for an unfortunate situation. Another was the snowplow effect. In the last downturn, everybody was using the term kicking the can down the road. And a couple people there mentioned the snowplow effect as banks are delaying decisions about refis and loan maturities and pushing them off. One uncomfortable visual, Manus, that got a lot of attention last night was in reference to the fact that a lot of private lenders are coming in and they're chasing deals without necessarily doing a lot of robust underwriting. And they use the term, you don't want to be swimming naked when the tide goes out, which apparently was a Warren Buffett quote that the audience seemed to really like for some reason.
Interesting that you bring that up, because this is something one of our longtime listeners mentioned to me about a month ago. And this is not about dignity or lack of dignity or fighting against foreclosure versus giving the keys back. His observation was that any stigma about defaulting or any stigma about giving the keys back is now gone when it comes to offices. For many years, people would fight tooth and nail to not have that black mark against them, that they failed to pay off a debt. They didn't want to have that stigma attached to their borrowing history, and they would avoid defaulting or giving back the keys at all costs. Now, particularly with offices, that concern is out the window. Nobody is worried about that. They're just worrying about, how do I get out from under this problem with the least amount of damage right now? The image of Eddie Murphy in Trading Places, right? Between higher food prices, home affordability, inaffordability, I should say, and the lack of the CRE market being on fire. I just remember his remarks about the futility of parents working overtime so they could afford to give their child the G.I. Joe with a Kung Fu grip for Christmas. And that kind of it feels a little bit like that right now, that we are on a treadmill, that even though the treadmill's moving and maybe we're making a little bit of progress, it's a grind right now.
Let's dig into our segments on some of the transaction comps. So let's start with who's looking for space.
Yeah, we had a couple things in this week as I bring up my notes, as I go to the other part of my computer, which, as always, has 70 things open at the same time, including my fantasy football for tonight, sadly. Who's looking for space? A couple of things here for brokers out there. Tech giant NVIDIA is said to be looking for 300,000 square feet in Austin. Justin Sayers of the Austin Business Journal with reporting there. So game on in Austin as people try to land the big whale in that town. In California, not quite the same size, but also a potential six-figure one. The Santa Clara Valley Transportation Authority, the SCVTA to locals, they're looking for between 75,000 and 150,000 square feet for a new HQ. Reporting there from the San Jose Mercury News. The Real Deal and follow-up reporting said one West Santa Clara out there, Urban Catalyst's Paseo, those two could be candidates for that particular space.
I thought the Austin and San Jose story are kind of two sides of the coin, where Austin's had some pretty interesting stories. I know you have another one later on IBM. It continues to see a resurgence in some of their office leasing and office interest, as opposed to San Jose, which has a vacancy rate of about 31% in the second quarter. So you start to see a difference in some of these cities and how they're able to draw people back to offices.
It hasn't always been a straight line up for Austin. I think at times there's been a little bit of overbuilding there. But by and large, people want to be there. That's where there's a big pool of talent, just like there was in Silicon Valley. We had that resurgence in Pittsburgh because of the proximity to Carnegie Mellon. We've seen it in the Triangle area down in Raleigh-Durham. It's a real asset for communities that have these colleges that really lean in on the STEM disciplines and can keep a high quality of life. So you keep the young people from leaving once they graduate.
And now let's go to speaking of leaving. Who's leaving?
Who is leaving? Let me go back. We got a couple of things here. I'll run through three in very short order. The really sad one is in Portland, where a U.S. bank has announced that it will not renew its lease at Big Pink. That's what locals call the 1.2 million square foot U.S. Bancorp Tower. Reporting there by Andy Gigerich of the Portland Business Journal. That's a real blow for Portland. Portland is already struggling with quality of life issues. We've seen some vacancies there before. The U.S. Bank is a big employer there, and for them to not renew at Big Pink is a disappointment. In New York, at 101 Park, two major tenants are set to vacate about 102,000 square feet of office space. Those tenants would be Morgan Stanley and Tiger Management. 101 Park is really right outside Grand Central Station. So you think it would be one of those situations where it's so well appointed, the building, and so close to a major transportation hub that it would be immune to this type of vacancy. But nonetheless, Morgan Stanley will be vacating 50,000 square feet in September, and Tiger will be leaving in December, 52,000 square feet. The news there came from Kroll, which does a great job covering the commercial real estate and CMBS markets. Lastly, taking us back to Austin, Martha promised this one. This is a mixed green. Facebook announced that it is shedding 300,000 square feet in Austin. This is an example of Facebook just having too much space and retreating. But the silver lining is that IBM has stepped in to fill the gap. IBM will assume the lease for 320,000 square feet at the Domain in North Austin that Meta is vacating. This is a bad piece of news for Hines, however. IBM had previously announced a deal to take a development project space from Hines. That deal is now off. Reporting on this story from Cody Baird of the Austin Business Journal.
And now we're going to go into who's moving. And the first story brings me to Hellman's is moving to Hoboken, is basically how I'm going to wrap that up.
I'm not a big mayonnaise guy. Like I never have been. I'm a mustard guy. That's just the way it is. Not, it's, I don't know. Too much mayo is just like, I don't know. It's the first sign that a sandwich is going half eaten and then making its way into the trash. So the story here is that SJB Properties has signed a lease for 111,000 square feet with Unilever. Unilever is the consumer goods giant. They'll be moving to Hoboken. In addition to Hellman's, they also make Dove soap, which I'm not nearly as averse to as I am mayonnaise, and Vaseline, which I'm quite indifferent towards. I don't use a lot of Vaseline. So they're moving to 111 River Street, the Waterfront Corporate Center. In a bittersweet story, law firm Smith, Gambrell, and Russell is headed to the John Buck Building, 155 North Wacker. They will take 57,000 square feet there, occupying 2 floors starting in 2026. Why is this bittersweet? The firm is downsizing from 120,000 square feet at 311 South Wacker, which has had its share of problems over the years. I won't get into them all, but the property value there has been slashed. It's now well below the outstanding loan balance and problems everywhere. We're reporting on this story from Sam Lounsbury of The Real Deal.
For this next segment, who's fighting? I'm sensing a song coming on.
My hips don't lie, right? Like the Shakira song goes. Who's fighting? Who's fighting? Who's fighting against the tide to do things with office when everybody else is throwing in the towel? These are my favorite stories. In the past, I've mentioned Related as everybody is leaving San Francisco in droves. Related is trying to put up that big tower in San Francisco. I said I am rooting more for them than anybody else because I love the underdog. I love them being in there trying to do something in a market that's distressed and needs help. Here are two stories that are of similar ilk. In New York, first of all, this comes from Elizabeth Cryan of The Real Deal. Gary Barnett's Extel Development has filed plans to put up a 32-story office tower on Fifth Avenue. This would be in around 47th, 48th Street. It will occupy almost 900,000 square feet at 574 Fifth Avenue. Talk about a leap of faith and a vote of confidence. Gary Bartell jumping in there with 900,000 square feet of office space at a time where office is on the ropes in New York. In San Francisco, this reporting from Stacy Corso of BizNow. Blackstone has landed a loan extension on the Schwab building in San Francisco. This is 211 Main Street. Schwab is the sole tenant. The loan, which is sizable, it's hundreds of millions of dollars, matured in April. It looked like a lot of other loans in California for offices that was headed to deed in lieu or selling at a discount or foreclosure. Schwab has already said they're moving to Texas. Their lease ends in 2028. They only occupy about a third of the building right now. Yet, even with all those headwinds, rather than give back the keys, Blackstone said, we are going to fight. We're going to negotiate a 4-year extension, which pushes the maturity date out to 2028. I believe they got a commitment from Schwab to continue taking a third of the space beyond 2028. And again, this is a situation where the path of least resistance was Blackstone throwing in the towel. And here it is, them running into San Francisco when everybody's running out. And I have another comment about that momentarily, but I want to hear Dianne, you and Martha first.
Yeah, it's interesting. No defaulting with dignity on that one, right? The thing that jumped out when you were talking was it's fully leased 3.5 years into the future. That's a long-term look at the market. I think good news all around. It's always interesting when someone jumps into a market when others are rushing out, and then you watch to see if others follow thinking, okay, well, if they're there, maybe we should start poking around there as well.
This is my 4th or 5th year doing a podcast after 9/11. And I never like the day to go by without recognizing those that run into scary places when everybody's running out. It still feels like yesterday, 9/11 taking place. Richard Hill, formerly of Morgan Stanley, put out a really moving piece about one of his coworkers that perished that day. A former coworker of mine put a piece out, I don't want to name her name, about her brother. So many people were impacted. So many people were touched by that day. And I never liked the day to go by without recognizing the pain that so many people felt on that day, but also the heroism that our police and fire and our medics and everybody else exhibited that day. It's just something that should never, ever be taken for granted as a society. So there I am on my soapbox, and now I'm getting down.
Thanks, Manus. Can I just jump on that for a second? I had the good fortune at the CREI summit today to hear a strip mall guy in person on a fireside chat with Ken, who runs the CREI summit. And he spoke quite a bit about why he started Strip Mall Guy, because it gave him the freedom to post without having his name associated with it. Because early on, he was very nervous about how people would respond to his post. And of course, now he has a record high following. But on 9/11, he typically posts a story from when he was 19 and sitting next to this man at a baseball game, and he was there by himself. And so was Strip Mall Guy as a teen. And they struck up a conversation, and the guy gave him his business card. He worked at World Trade Center and he died on 9/11. And Strip Mall Guy posted it and got, a wonderful response from people yesterday, including the guy's family, who was so grateful to hear about the impact that he had on his life. But he said there was this one guy who commented saying, How could you use that memory as a way to promote yourself? And he was so hurt by that comment. And he put it in the context of, being aware that you're going to get negative publicity and positive. But it was such a beautiful story about an impact that one of the victims had on him at 19. And he still remembers it in a very positive way every 9/11.
I know Strip Mall Guy, and as you do, he's genuine. He's heartfelt. He picks up the phone for anybody. If you ask him a bona fide question, he's going to give you a bona fide answer. He's going to take the time to inform you. Everything is heartfelt from that guy. And if you want to read his comments about this, it is on his Twitter account today. It's worth reading. Not for a moment did it dawn on me that this was self-promotional. I thought it was heartfelt. It hit completely the right nerve, and good on him from using this vehicle to remind people that we don't live by CRE alone. We live by each other and our connection to one another.
On that note, as many people have said, I'm not the first to say it, September 12th was probably the best of Americans' behavior that you've ever seen. So I think we'll leave it there and exit with a thought about that. Thanks to our producer, Josh Bruning. Please join us every week as our team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcasts@lightboxre.com.
Thank you, everybody, for listening, and let's go.